Hello and welcome to another video on IND AS from GJ Management Consultants. So today we are here to present on IND AS 37, which is provisions, contingent liability and contingent assets. The key topics that we are going to cover today are objective and the scope. We'll talk about the key definition, which is impacting the IND AS. Quick look at the recognition criteria for the provision, how provisions are measured, discounting of the provision, and finally the review and the reversal of provision. We look at contingent liability, the definition, snapshot of differences between the provisions versus contingent liability, what are contingent assets, what are onerous contract, and how we have to deal with asset retirement obligation. We'll talk about restructuring provisions and reimbursements, disclosures, and finally differences, if any, between IND AS 37 versus equivalent international accounting standard 37. So we'll move to the first slide then. Okay, now we'll talk about the objective and the scope. See, the objective of IND AS 37 is to ensure that appropriate recognition criteria are applied to the provision, contingent liabilities and assets are properly disclosed, and financial statements reflect the present obligation, not the future intentions. So, which means that it covers the three aspects. It covers the aspect that if at all there are provision, then it has to be properly accounted for, properly recognized. If we have a situation wherein we have a contingent liability or a contingent assets, that should be properly disclosed, and our financial statement should reflect the present obligation and not the future intentions. This is the main objective of the IND AS 37. And if we'll look at the scope, so it applies to provisions, it applies to contingent liability, it applies to contingent contracts, it applies to onerous contract, and it also applies to decommissioning and restoration obligation, which is ARO. But it excludes the financial instrument which is being covered under IND AS 109, insurance contract 117, income taxes IND AS 12, and employee benefit IND AS 90. And this inclusion and the exclusion within the scope and the objective is absolutely aligned with IAS 37. We'll move to the next slide and look at some of the key definitions. Okay, now we'll quickly talk about some of the key definitions of IND AS 37. So first we'll talk about the provision. So typically when we're talking about provision, so provisions needs to be created because we have a probability that there is some expense that is going to occur in the future. And that is largely because of the fact there were some past event which has triggered the probability of that expense to be incurred in the future. So there has to be a probability of the expense, and then at the time of booking or recognizing of that particular expense, it is largely we are not clear about the exact amount on which provision is to be created. So amount is not certain, the time is not certain, but there is a probability that the expense will occur in the future. So if you look at the definition, it's talk about a liability of an uncertain timing or amount. A provision is a liability of an uncertain timing or an amount that arises from the past event and expected to settle by an outflow of the resource. So which means that there's a probability that it has to be get settled through the outflow of the cash or the resources. Provision should be recognized when there is a present obligation. It is probable that an outflow of the resources will be required to settle the obligation, and the reliable estimate of amount can be made. When we talk about the liability, liability is a present obligation arising from the past event, settlement of which is expected to result in outflow of the resources. So basically, a liability is something which for which we have the confirmed amount, and then we have the total amount which needs to be settled. But provision is largely a kind of a scenario wherein we do not have the confirmed amount. We have a probable amount that needs to be calculated basis the best available estimates, and then it has to be settled in the future basis the event that has been triggered in the past. When we talk about the contingent liability, it's possible obligation. So which means that there is no probability, there's a possibility. Present obligation not recognized because outflow is not probable or amount cannot be reliably measured. So typically when we talk about the contingent liability, it's a possibility and there is no probability of the occurrence of that particular event in the future, which results in the actual outflow of the cash. And hence in all the possible scenario, contingent liabilities are largely disclosed in the balance sheet. Similarly, contingent asset is a possible asset that arises from the past event but is not yet certain. Contingent assets are not recognized in the financial statement, but are disclosed if their existence disclosure is probable and their measurement can be reliably estimated. So, if we have a situation wherein we need to have a contingent asset, then in very ideal scenario, it has to be disclosed only. There is no concept of booking that particular asset. Contingent liability and contingent assets are both disclosed in the notes, and in some scenarios, contingent liability are even not disclosed if the possibility is very remote. When we talk about the onerous contract is a contract where the unavoidable cost exceeds the expected economic benefits. So, which means there is a situation wherein the uh, cost of not fulfilling the contract is more than the revenue or the benefit that is actually going to realize from the contract. So, contract where unavoidable cost expected exceeds the economic benefit, that is normally called as an onerous contract. How the provisions are recorded, what is the recognition method, what is the measurement criteria, how the contingent liability, contingent assets, and finally the onerous contracts are recorded in the books. We are going to have separate slide on each of them. But with the key definition, when we try to compare this with IAS 37, it is absolutely aligned. So we'll move to the next slide. Okay, now we'll talk about the recognition criteria for provision. So provision is recognized only if all the below conditions are met. So what are those? There has to be a present obligation. So which means that we know that we have to settle an amount, but that amount is not certain. But that amount needs to be settled, and when we settle that amount, it would mean a probable outflow of the economic resources. The reliable estimate can be made with degree of the probability that we have, and there has to be obligation basis the legal or constructive contract. Either it has to be legal or it has to be by the way, by the constructive way, which means like established practice or published policy, which trigger a particular provision that needs to be created. So all these three conditions needs to be met, then only we can create the provision in the books. And if any of the condition fail, there is no provision required. So when we talk about the present obligation, it has to be legal or constructive. And what are the legal obligation? It is through a contract. Law permits that, or it has to be regulatory provision. But when we're talking about constructive obligation, which means that it's an established practice, a published policy, or a valid expectation created. So, for example, company has publicly announced the plant closure and the compensation plan. Employee expect compensation. So, provisions are required even before the legal agreement. So, it means that past practice, a published policy, or any of the expectation that has been created, basis which the organization is presently obliged to expense of which to expense of and the outflow of the resources, and in that case we have to create the provision in the books. This is the best estimate that are available at that point in time, and this recognition criteria for provision is absolutely aligned with IAS 37. So we'll move to the next slide. Okay, now we'll talk about the measurement provision. How we have to value the provision. We have to assign value to the provision. So provision is equal to the best estimate of the expenditure required to settle the obligation at the reporting date. So at the reporting date, whatever best estimates that we have, basis which we could able to establish the amount that needs to be determined basis some judgment and basis the past practices of the organization, and they have to then create an amount, find a finalize an amount, and then that amount would be reflected in my provision. So methods are expected value, which is a large population, or let's say if it is a most likely outcome, which is single obligation. So depend upon the kind of an obligation, we have to create the best estimate for the provision. So if we are talking about the warranty provision, which is expected value, so we are talking about a situation wherein warranty provision is to be created. We have created a scenario wherein the minor defect is a 60% probability and the cash outflow is 1 lakh. Major defects probability is 40% with the cash outflow of 3 lakh. So if we look at the situation here, the provision is to be created for 1,80,000, and this treatment or calculation of the method of provision is absolutely aligned with IAS 37. So we'll move to the next slide then. Okay, now we'll talk about the discounting of the provision. So we know that if the time value of money is material, then definitely the provision needs to be created at a present value, and we have to use the pre-tax discounting rate. Best scenario is the asset retirement obligation, because we have to pay for that amount after certain period of time, or largely after the useful life of an asset, which is like in future, and we have to then create the provision for the retirement obligation. That provision would be created at a present value, which is by applying the discounting factor. So example is discounting provision is, let's say we have a cash outflow after 3 years, which is like 10 lakh. Then we have to create the provision, and then we have to create the present value of the provision, which is like 7,90,838. This is the provision that would be created, and each year a discounting will be happen, and liability would be increased accordingly. And this treatment is absolutely aligned with IAS 37. So we'll move to the next slide then. Okay, now we'll talk about the review and the reversal of the provision. So we have created a provision with an assumption that we know that there's a probability in the future basis which we have to create that amount in the books, because that is a present obligation, but outflows happen in future. But sometime it may happen that the probability got reduced, or the provision is no longer required. So what is the treatment in that case? So basically we have to review at each reporting date the provision that has been created, just to make sure that the probability or the certainty with which we have created the provision still exists or not. And if there is a decrease in the probability, then we have to decrease the provision, and then accordingly we have to make the changes in our financial. So basically increase or reduce the base the latest estimate, and then reversal if no longer required. It also permits the reversal of the provision if my probability for outflow of that resources from the current from the present obligation is zero, or it is very remote. So provision cannot be created for the future operating loss. This is a thumb rule. If we anticipate that there are certain losses that's going to happen, we cannot create the provision for it. And this treatment of review and reversal of provision is absolutely aligned with IAS 37. So we'll move to the next slide then. Okay, now we'll talk about the contingent liability. What are the contingent liability, and then whether it needs to be recognized, and if not, what is the treatment? So for contingent liability definition is, we know that it's a possibility that and that there would be an outflow of the cash. So which means recognition is not required. There is no recognition. Disclosure, yes. So disclosed unless probability of outflow is remote. So if it is very remote, then we do not have to disclose that even. But if possibility of the outflow of the resources is there, then we have to create a disclosure note so that we can make sure that we are transparent in terms of mentioning the fact that there is a contingent liability that exists at a balance sheet reporting date. So example of contingent liability are: company faces a lawsuit, probability of losing 30%, amount is uncertain, no provision, only disclosure. So typically when we look at the percentage here, 30%, if we look at the IND AS 37, it does not prescribe any percentage basis which we have to create the provision, or we have to assume it as a contingent liability. It has to be basis the estimates. So logically, if any estimates or any probability is there for where outflow of the resources is greater than 50%, then largely organization create the provision for that. But wherever there is a probability or outflow of the cash is less than 50%, then they do not create the provision, and they normally treat it as a contingent liability. And this alignment is largely aligned with IAS 37. So we'll move to the next slide. Okay. So for the interest of making sure that viewers and subscribers can understand the concept in much better way, so we have created a table here which clearly demarcate that when we have to create a provision, or when we have to take it as a contingent liability. So provision is present obligation, contingent liability is possible obligation, or present obligation not recognized. So which means that present obligation needs to be there for any provision that needs to be created. But if present obligation is not there, or if present obligation is there but probability is very remote, then we need to create a contingent liability. Obligation exists, for the provision, but for contingent liability, obligation is uncertain. Probability of the outflow probable more likely than not, and for contingent liability is possible or not probable. Recognition in balance sheet, that we have to recognize that, but in case of contingent liability, it only requires a disclosure, so there is no recognition. Measurement basis is the best estimate of expenditure. It is not required to be measured. Initial entry is we debit our expense and credit the provision. There is no entry because there is no recognition. Disclosure is mandatory, yes. It again for contingent liability it has to be yes, unless and until it's very remote. Review required, yes, at each reporting date it's a mandatory required. Likewise for contingent liability, it has to be mandatory required, because it may so happen that a particular contingent liability can turn into a provision, considering the fact that the probability of the amount has been increased, and then we have a present obligation, but amount is getting more probable, and hence we need to create a provision. So real estimate, yes, adjust the provision. Sorry, re-estimate, yes, we have to adjust the provision. For re-estimate, yes, probability reassessed and may become a provision. So reversal, if no longer probable, we can definitely reverse that. And in case of reversal for contingent liability, it has never been recognized, so there is no reversal required as such. So if we quickly look at how a particular situation, a provision can be write off, and then how can write off or reverse, and then definitely there can be a situation when a contingent liability can be converted into a provision. So we have shown that in below table, wherein we are saying that if the possibility becomes probability, then contingent liability becomes provision. If probability is not probable, then provision has to be reversed. If uncertain becomes remote, then there is no disclosure. So this is a thumb rule that we need to follow while we are accounting for provision and when we are disclosing the contingent liability. So we'll move to the next slide then. Okay, now we'll quickly talk about the contingent assets. So when you're talking about contingent assets, so contingent assets are never recognized in the financial statement because it goes against the concept of conservatism. Recognition may result in recognizing income that may never be realized, violating the prudence. So when we're talking about the contingent assets, so if it is remote, there is no disclosure. The same way contingent liability, if it is a possible, again there is no disclosure. Probable, then disclosure in the notes, and if virtually certain, which means that we have a certainty that we are going to get that amount, that we have to recognize as an asset. So which means that it is no longer a contingent. So this is a thumb rule that we have to follow for a particular contingent asset. So we have quickly shown an example through which we can demonstrate that how we have to record for the contingent assets. So company has a filed a claim against the supplier. Chances of success is 40%. No recognition, no disclosure, because we are going by the fact that if it is less than 50%, then for even that we do not need to create any contingent liability if it is not our present obligation. If probability becomes virtually certain, then definitely we have to recognize it as an asset. And this treatment is absolutely aligned with IAS 37. So we'll move to the next slide. Okay, now we'll talk about the treatment of onerous contract. So a contract where unavoidable cost exceed the expected economic benefit, that is a onerous contract. And then what we have to do, we have to create the provision because we know that we have to settle an amount in the future for which there is a present obligation. But provision has to be created lower of the cost to fulfill the contract or the cost to exit, which is the penalty. So we have to create the provision for the lower of the amount. And it has been demonstrated through an example here. So contract revenue is 5 lakh. The cost to fulfill or complete that contract is 7 lakh. And if we exit that contract, we have to pay off penalty of 1 lakh 50,000. So in that case, we have to create the provision by creating the provision of 1 lakh 50,000 because that is lower of 1 lakh 50,000 or lower of 7 lakhs. So whichever it is, the cost to fulfill is that we have to create the provision for the same. So we are creating the provision of 1 lakh 50,000. This treatment is absolutely aligned with IAS 37. Okay, now we'll talk about the treatment of provision when we are having the asset retirement obligation. So provisioning is required at the present value for the future obligation towards the asset restoration expense. So we have already discussed this in the earlier slide. So we have demonstrated with an example here because let's say we have a decommissioning provision, or we have to completely install a oil rig, and the decommissioning cost is 10 years. After 10 years is 20 lakh rupees. So what we have to do, we have to first get this to a 20 lakh value to the present value by discounting the value at a particular discounting rate. And then what will happen? We have to create the provision for that. And every year, the provision would be added by applying the discount factor, and it would be increased, liability would be increased, and provision would be added every year until it is finally paid off when we have to pay that expense at the time of the final restoration. This treatment is absolutely aligned with IAS 37. So we'll move to the next slide then. Okay, now we'll talk about special cases like restructuring, and how we have to create the provision for the restructuring. So before that, let's quickly spend some time in understanding what is restructuring. So restructuring is a program that is planned and controlled by the management and materially changes either the scope of the business or the manner in which the business is to be conducted. So which means that there has to be restructuring in the ways of working, the business model, or the fundamentals in the ways of running the business, because of which there is some churn of the employees, or there is some changes in the dynamics, which leads to incur certain cost at that point in time when we have taken that decision, or decision is in the process of the crystallization. Provision is recognized only when both the conditions are met. What are those? The detailed formal plan exists, and valid expectations is created among those affected by the program or the restructuring methodology. So which means that we have to recognize the provision once we have the detailed formal plan, which means that what is the detailed formal plan is going to help us with. It helps us to understand the business which is affected, the employees that is being affected, the expenditure that needs to be incurred, and the implementation timeline. So that business plan needs to be made available once we have decided the restructuring, and then we can only create the provision once we have the detailed formal plan. And secondly, valid expectation is created. So which means that we have the absolutely alignment in terms of when we are going to start that program, uh, when we are going to announce that publicly, and then definitely it has to have the proper timeline. Bare management intention or the board approval is not sufficient. So what costs are included in the restructuring provision? Only the direct expenditure necessarily caused by the restructuring. For example, what are those? Employee termination benefit, lease termination penalties, and the contract cancellation costs. Because we are doing the restructuring of the business, we definitely have to incur some expenditure in terms of the settlement of the employee. We have to shut down the some of the contract, or we have to early close some of the contract, because of which we have to pay the penalty, or we have to close some of the lease contracts, and we have to cancel some of contracts, because of which there is a payout. And all these costs which needs to be paid out as a part of the restructuring needs to be provisioned off. What costs are excluded? So future operating losses, training or the retraining costs, marketing and advertising expenses, cost of relocating or reorganizing the continuing operation. Those costs relate to the future activities and not the present obligation. So any costs which is not directly related with the restructuring program, but are required as a part of a future action plan to manage the business or the operation post restructuring, those costs will be excluded from creating the provision of the restructuring. So with this, we have closed with the restructuring provision. We'll move to the next slide. Okay, now we'll talk about the reimbursement. So which means that we have created a provision, and then we got some reimbursement from the third party. So what will happen? A reimbursement arises when an entity expects some of all of the expenditure required to settle the provision be required from the another party, such as an insurer, a supplier, a contractor, a third party under a contractual obligation. The obligation remains with the entity. Hence, we have to create the provision for the entire amount, even if reimbursement is expected. So, reimbursement shall be recognized only when it is virtually certain that reimbursement will be received if the entity settled the obligation. Probable is not sufficient, which means that we cannot create a reimbursement asset in the books of account if it is not certain, or we have do not have a virtually certain scenario wherein we are going to receive that amount. Threshold is virtually certain, higher than the provision recognition. So which means that rather than it is a probable, which is like 50% threshold which you normally apply, it has to be more than that, wherein we are virtually certain that we are going to receive that amount. So reimbursement needs to be recognized as a separate asset. It will not be netted off with my liability of the provision amount recognized shall not be exceeds the rated provision. This is very, very important, that we cannot recognize an amount which is more than the provision amount. And second, no netting is allowed in the balance sheet, but it can be netted off in the so which means that in the P&L we can show the reimbursement as an less minus item to my expense, which means like if my provision is 10,000 and receiving some reimbursement of 2,000, then we can show 8,000 as an expense, but in the balance sheet it has to be shown as separate. 10,000 would be liability, and then 2,000 would be shown as a reimbursement asset. So this treatment of reimbursement is absolutely aligned with IAS 37. So we'll move to the next slide. Okay, now we'll talk about the key disclosures that are required as a part of this standard. So IND AS 37 required disclosures as below. For each provision, we have to make sure that opening and closing balance should be there. Any addition and utilization should be mentioned available. Nature of the obligation, expected timing, and the uncertainties. And then for contingencies, we have to mention the nature of the contingency, the estimation of the financial effect, and then the uncertainties attached to it. So all these attributes related to the provisions and contingent liability needs to be disclosed in the notes to make sure that this absolutely transparency is available. And these disclosures are absolutely aligned with IAS 37. So we'll move to the final slide then, which is to showcase differences, if any, between IND AS 37 and IAS 37. Okay, now we'll talk about differences, if any, between the IAS 37 and IND AS 37. So largely they are same. There is no difference as such which needs to be mentioned of. So it's absolutely aligned and largely converge. Some differences can be there in terms of disclosure, but otherwise there are no differences which are needs to be mentioned for IND AS 37 and IAS 37. So this is the last slide. So we'll move to the thank you slide then. So thanks to all my viewers and subscribers for watching this video till end. It's my sincere request to please cascade it to the larger audience so that they can also get the understanding of the IND AS 37, and we'll come up with the new IND AS very soon. Thank you and have a good day.